Hello and welcome everyone to our 2021 halftime report with David Waddell. Fasten your seatbelts. David is taking us back to the future today with our outlook for 2021 and beyond. I'm Teresa Bailey, Director of Development, also a wealth strategist here at Waddell & Associates. David, as many of you know, is our Chief Thought Leader as well, and is often seen on CNBC, Fox Business, and many other news outlets. And we rely on him internally for outlook on our portfolio and investment options, as well as he is our fog cutter of information and fearless leader. Today, after our presentation, hopefully we'll have time for a few of your questions. Please input them into the Q&A box. Those of you that are on PC version of Zoom can do that, and we will see them and get to them at the end. You can always find us and more information about us, as well as join our email list. We send an email out every Sunday morning at www.wealthstrategists.com. And with that, unless I've forgotten anything else, David, I'm going to hand it over to you to take us back.
Thank you, Teresa, as always. So I really appreciate you all clicking in for this version of the halftime report. This year has been tremendous so far, and I called this presentation Back to the Future because I don't think any of us have experienced economic growth rates like this since the mid-1980s. And so I went back and I looked at the mid-1980s, and while I found a lot of great economic and market data, I also sort of took some time thinking through the cultural environment and recognized, that was a super upbeat time. It was really cheerful. And as I was reflecting upon where we are right now, I don't know why, but it doesn't seem to be nearly as upbeat, nearly as cheerful. Now, you probably have already in your head jumped to a couple of reasons for that. And I'm not going to present on that. But what I am going to do is rather ambitious. Today, not only am I going to share sort of economic and market analysis, but I'm also going to try to cheer you up a little bit. So it's an ambitious agenda, could be a little bit of a wild ride in a DeLorean. So for this, let's take a moment and go back to the future. But before I do, here's some legalese, which is very, very, very present. I'm not even sure in 84 you had to do anything like this. But it's better that you do. Before we go forward into 2021, so we can jump backwards, we need to review 2020's pandemic framework. You've seen this a lot over the last 18 months, but it still holds. And as I always say, if you don't have a framework, you can't have a strategy. And so I'm going to use this framework to sort of move us to the present once again. All right, now when the pandemic hit, remember we opened the history books and went back and researched the previous 4 pandemics in the post-1900 sort of period over the last century. And remember we had 4. We had the Spanish flu that killed like 40 or 50 million people that were accounted for across the planet. Then you had the Asian flu back in 1958, which killed 1 million people plus. Remember, overall population levels were lower. And so the Asian flu was pretty much about the same as what we experienced with COVID. Then we had the Hong Kong flu just a few years later. That was deadly. And we had the swine flu that was particularly contagious, but not all that deadly. Of these 4 pandemics, really only one was a health crisis, also a recession, and also a bear market, and that was the Asian flu. So we continue to use that as our guide star to help us navigate through the environment of COVID-19. So let's go back in the time machine to 1958 and reflect upon what happened during the Asian flu. We did see a massive recession. Specifically, it hit hard in the first quarter of 1958 as case counts were peaking. People were super concerned. It was a voluntary recession. The reason I say voluntary is that people quarantined and isolated on their own volition for self-responsibility and care and protection. There were no government mandates at the time to stop participating in the economy. And then shortly after the turn of the calendar, a moderately effective vaccine was launched into the marketplace prior to the creation of the FDA. You could just sort of get that out there. And it was put into the marketplace, and animal spirits returned. It was an unassisted recovery. The reason I use the word unassisted is because there wasn't any government stimulus that I could really find, either on the Federal Reserve side or the congressional side. And yet, nonetheless, people were so excited that they were alive, and all that pent-up demand sort of came to fruition, and the economy grew at a 9% rate coming out of the Asian flu. So our base case for COVID was that there'd be a recession, and then there'd be a tremendous recovery, probably more than people would expect. However, we did have a whole lot of government interference in the COVID recession. Recall that they basically forced us to quarantine, locked the economy down as the antidote, if you will, to the spread of the coronavirus. And on an annualized basis, the economy recessed by 31% on an annualized basis. It makes that number seem bigger than it is, but it was still the biggest number that we had on record, and that includes the Great Depression. So it was a significant drawdown in economic pace, and obviously job losses were huge. I think we went to a 14-15% unemployment rate. Very, very sharp, very nasty COVID recession by mandate. Well, because the government took it away, basically $2 trillion of economic activity, they gave us something back. And I need to update this slide, but the Federal Reserve at this point, in response, has really launched about $4 trillion of quantitative easing. They're printing about $120 billion a month and spending that on treasuries, mortgages, and they've maintained that pace after a large infusion, immediate in reaction to COVID. So we're at about $4 trillion in quantitative easing. So you can already add $1 trillion to this number. They did $4 trillion in loan guarantees, basically backstopping all the debt in the marketplace, which enabled businesses. Bankruptcies were actually near an all-time low. Defaults were near an all-time low. The Fed basically backstopped all debt out there. And then, not to be outdone, the congressional leaders came together with the president, 2 presidents now, and put together $5 trillion in fiscal stimulus. But wait, there's more. There's $4 more trillion in debate right now, $550 billion with the current, hard infrastructure plan, and then another $3.5 trillion. Details haven't really been filled in yet with the human infrastructure plan, or the anti-poverty bill. We'll see where all that goes. So that could be another, $4 trillion in stimulus on top of that in response to the COVID coronavirus recession. So $2 trillion in drawdown, 12 to 13 to 17 trillion in response is a pretty serious response for a $2 trillion recession. And that response is showing up everywhere. So we now have record personal income, and it's important that you let that sink in. While the economy was going through a rather draconian sort of recession, personal incomes were going up 17%. This is annual highs as of the first quarter, I believe. So record gains in personal income thanks to all that stimulus. And also record highs in personal income. So as a run rate at the end of the first quarter, personal income across the United States of America was about 22 trillion, well above the 19 trillion pre-coronavirus. So massive stimulus, massive results. Household net worth has also gone to record highs. In fact, through the first quarter, right? So the entire pandemic period, basically, total household net worth, your assets minus your liabilities, your house, your stocks, your Bitcoin, your everything, went up 23%. We've never seen gains like that in history. And in fact, household net worth today is about $20 trillion larger than it was before the pandemic. The US economy in size is $20 trillion. So massive, massive gains in income, massive, massive gains in household net worth. But wait, there's more. When you put it all together, 2021 did have a drawdown. It was the worst GDP contraction since 1946. We were down 33.5% by the end of the year. It was worse, and then it got better as the year went on and the stimulus took hold. But next year, or this year, I should say at this point, expectations are for around 7% growth. Now, real quick sidebar. For those of you who pay attention, the US economy grew 6.5% or so in the last quarter, and people said, oh, that's a GDP miss. Well, the inflation rate was like 5 and change on top of that. So the nominal GDP growth rate was around 13% last quarter, year over year. So this growth rate is unprecedented. Don't let anybody tell you different. The last time we saw 7% growth, like we might see this time this year, was when Kevin Bacon was just breaking hearts in 1984 with the release of Footloose. 1984, best year ever. Any questions on that? See me after. But it doesn't stop there. If you go to next year, the expected growth rate for next year is 4%, 4% plus. We haven't seen a growth rate like that since Britney Spears released Oops, I Did It Again. For those free Britney people on the call, you're welcome. So it's been 20 years since we saw a 4% growth rate. It's been nearly 40 years since we saw a 7% growth rate. That's the zone we're in today. Pretty awesome. Record incomes, record net worth, almost record total GDP growth. So in the words of Buster Poindexter, how you feeling? Well, this is a chart of the Consumer Sentiment Index going back to early 1980. And you can see back in 1984, we were feeling hot, hot, hot. So the index was above 100. Everybody was pretty happy. There was a lot of prosperity, a lot of economic growth, a lot of cool things happening. Great music, great movies. It was just 84 was astounding. 1999 wasn't all that bad either, right? Actually, consumer sentiment was even higher in 1999 when Britney released Oops, I Did It Again. So here we are today. Spicoli is confused. Record income, record net worth, record GDP growth, and yet basically the mood is average, less than average in terms of consumer sentiment. So that's a bit of a head scratcher, and it makes me ask, what is it that scares you? So I reflected back on a lot of client meetings and a lot of things I see across the internet to try and determine which of the big things out there that are really causing people to be not pessimistic, but not nearly as happy and optimistic economically, really, as they should be. So is it inflation that scares you? Well, maybe. I mean, there's a lot of nightmare fuel on the internet around this is going to be runaway inflation. At worst, or at best, this is the stagflation of the 1970s. And indeed, there has been a spark higher in inflation. The last inflation report, the one the Fed reads, inflation was up 3.5%. We haven't seen rates like that since the early 90s. So it's been 30 years since we've seen inflation spark at this level. If it stayed at this level, what would that mean, right? Would that derail the economy? Would the Fed overreact? It is definitely something to be concerned about. But you know who's not concerned? The Ghostbusters. Egon's not concerned because what he knows is that inflation in the short run is solved by inflation. So the cure for higher prices, for those of you in commodity land, is higher prices because more supply comes online or it crimps demand. Either way, high prices, it's difficult to sustain. And if you look at a longer term market-based inflation forecasting tool, out 10 years, the break-even inflation rate's only 2.5%, 2.3. And that just takes us back to the long-term inflation outlook pre-COVID. So there is no long-term inflationary concern in the markets, even though there is a market move higher in inflation in the current environment. Thank you, Econ. So what about government debt? Ooh, we talk about this a lot. And so this is a chart actually generated by your government, except for the Zool guard dog in the upper right-hand corner. Going back to 1900, you can see we didn't have much debt, and then we had a bunch of debt in World War I, comparatively. Great Depression jacked things up. World War II, we took on a bunch of debt. War machine kind of went away. We had the Great Recession, where we deployed fiscal stimulus like we hadn't done since really the Great Depression. And then we had the pandemic, which kicked things into higher gear. And then we've got the entitlement state. And so, oh my gosh, before you know it, debt can go from 100% of GDP on the government's books to 200% in GDP by 2050. That's kind of terrifying. But as Peter Venkman would tell you, right now in the United States, gross debt might be 120%, but in Japan, it's 220%. So public debt in Japan is already over 200%, which is the big scary number in that chart forecasted out in the US around 2050. And yet, the US 10-year Treasury bond rate yields 1.2%. The Japanese 10-year bond yields 0.05%, a mere fraction, basically zero. So the risk in having runaway debt, of course, is that you go through your Grecian moment and your interest rates spike, you can't afford them, and things start to unravel. Well, Japan is where we're forecasted to be in 2050, and their interest rates are a fraction of ours. So Peter says, you're not. Well, what about valuations? I hear a whole lot about this. If you don't remember, this is the librarian in the opening scene from Ghostbusters. Absolutely terrified me in 1984. Clearly, CGI has gotten better. Nonetheless, sorry, I digress. If you look at valuations in this chart going back to 1960, you can see the bubblicious period of 1999 when we got up towards 26 in terms of forward PE on the S&P, and today we're at 22. So the fear mongers on the internet are telling you that's it. This is the bubble. It's going to be a crash of dramatic proportions, a la what we saw between 2000 and 2002. That's pretty scary. Something to think about. But as the whole Ghostbusters team will tell you, what really matters in valuation is not the relationship between today's value and yesterday's value, but the relationship between the valuation of the stock market and the bond market, basically interest rates. So Egon, Winston, Peter, and Ray will remind you that back in 1999, we had a prevailing interest rate environment of about 7% for corporate bonds. And if you look at the prevailing rate today, it's about 2.38%. If you convert that to a PE, if you convert that to a PE, what happens is at 7, you end up at a PE of 14 or something like that. And at 2.38, you end up at a PE of 36. And so today's PE of 22 is about 40% cheaper than the PE on, there we go. About 40% cheaper than the PE on the bond market. So the bond market is way overvalued relative to the stock market. That was inverted back in 1999. So thank you, Ghostbusters. So outside the S&P 500, which is what I just referenced, things get even better. So in the US, like I said, the PE is 22, but outside the US, the PE is actually only 15 times. And even within the US, if you segregate the market down into large growth, small cap, mid cap, etc., large growth PE is about 28 and a half times. S&P, like I said, is about 22. Mid caps are 18. Small caps are 18, large values at 17. Developed international is 16.3. And if you really want to bargain, the emerging markets are trading at about 14 times. The long-term historical average for PE on the stock market is about 16. So outside of large cap US growth, things are really not that overvalued. So then I also see nightmare fuel about growth expectations are just way too high. And that's possible. This is the Citigroup Economic Surprise Index, and what it tells you is above the line, the economic data releases are better than expectations. Below the line, economic data releases are worse than expectations. And as of the most recent release, we were 3.4% below the line. So perhaps growth is rolling over. Now let's see what the Ghostbusters have to say about that. Well, growth rolling over because there's a demand shortage would be bad. Growth rolling over because there's a supply shortage, not really all that bad. Right now, when we had a jobs report this morning, I think the unemployment rate dropped to 5.4. If I got that right, we did about 900,000 new jobs, and we've done 800,000 over the past few weeks. This or months. This is the total job openings, 12-month change in thousands. And what you can see is the reopening economy, because it's fueled with all that stimulus, is absolutely starving for labor. There is 9.2 million job openings right now across the economy. And so the 800,000 people who jumped into the workforce on average over the last 3 months are answering the call, but there's still more work to do. And we may run out of workers by the time this thing ultimately rights itself. So there are shortages in labor that holds back economic activity. There are also shortages in goods. So this is kind of a wonky chart, but it's total business inventories to total business sales as a ratio. And I took it back to the early 90s. I don't know how far back the data set goes. It doesn't really matter because I don't think we've ever had inventories as tight as they are right now. So business inventories year over year have fallen 30% relative to sales. If you're trying to get boat parts or motorcycle parts or any kind of parts right now, you'll note that there are shortages everywhere. So you know what I'm talking about. So we've got shortages of labor, we've got shortages of goods, but there is no earnings distress present at all. This is a chart of the expectations in pink for the S&P 500 calendar year bottom-up earnings. We're at 200 now a share versus 163 before the pandemic. We'll be at 220, probably 225 next year. So earnings are absolutely surging. What I don't have is a chart on profit margins because I hear, earnings may be going up, but margins are going down because of so much inflation. So profit margins are actually at a record level right now to 13% and change across the S&P, which is just astounding. So businesses have gotten super resourceful, and they're doing all this with the unemployment levels, 7 million people higher than it was pre-pandemic. So they've gotten super efficient. Earnings are going absolutely through the roof and surprising to record degrees. But something clearly is amiss, as Winston notes here. This is a chart of the 10-year Treasury yield. And you can see, this is for the year, you can see that during the course of basically the second quarter, we were hovering around 1.6%, gathering what many thought was going to be steam to take out the 2% mark and march higher. And then we saw this dramatic fall off beginning in June to about 1.2%, which is where we closed yesterday. So if things are so good, why are yields coming down? Well, here's the reason. As the Ghostbusters discover with this chart, this is the number of new confirmed COVID cases per million people worldwide. And we are definitely in the third wave of this coronavirus. About 80 people per million worldwide are being diagnosed on a daily basis. We topped out at 120 or whatever, and we were at almost 100 back at the end of last year. So we're clearly in the third wave of the coronavirus, and that's making people nervous. You may not feel as nervous because you're a United States citizen, most likely if you're watching this, 50% of our population has actually been vaccinated, and this is two vaccines, so fully vaccinated. Outside the US, it's a very different story. So if you look at, I guess Africa is less than 1%. I think Australia, which is locked down now, is at 8%. You just kind of go around the rim. The Pacific Rim is really not very well vaccinated, and that's where the preponderance of cases have shown up. And so outside the US, only about 10% of the world's population is fully vaccinated. So while Delta is an irritant to us, it is legitimately frightening to them. So what happens when those overseas get scared? They sell. They sell risk assets. So if you look at the emerging market index, this goes back to June, right, which is when the Delta virus started spiking higher. It's down 6.5%. You look at the EFI, which is the developed international index, it's down 1.1%. So when those foreigners start hitting sell, when they're fearful, what do they go buy? They buy US dollars. And so the dollar is actually up 3% over this Delta scare period. What do they do with those dollars? They buy Treasury bonds, up 9% over that period. Remember, the yields go down, the prices go up. And they buy US large cap growth stocks like Apple and Amazon and Microsoft and Facebook. And the US large cap growth index during this Delta scare has gone up about 16%. So if you're wondering what's going on with the interest rate complex, it can all be correlated with the rise in case counts for Delta, the sales and those fearful overseas, the money flowing back into the US takes the dollar higher, takes interest rates lower because people buy treasuries, takes large cap growth stocks higher, and they're at an all-time high. But Delta is not the same as alpha, beta, gamma, whatever we've dealt with so far, in that, and this chart really sort of understates the distance between death at phase 1 and phase 2 and death rates today. It's a world chart, the data is not as good. To put it in context, in the United States, at the height of COVID back in February, I guess January maybe, we were running a death rate of about 10 people per million. Today we're running 1 person per million. In the UK, at the height of their fatality rate, it was 20 people per million, and it's about 1.5 people today. So the Delta virus is a whole lot less lethal because, a lot of the vulnerable have been vaccinated, and for a virus to be successful, it's better to not kill the host. So the COVID virus is evolving into a nuisance rather than being a death sentence. Swine flu, I think, was more like the Delta virus is today. Now, I'm not a scientist, I just aggregate data, but that's what I see. So I don't think Delta puts us back into closures and lockdowns, although I am seeing the masks go on. That's probably good hygiene, but I don't think all of this is going to be mandated all over again. So we don't go back to shut down economy. And also, I do, if you read the email a couple of weeks ago, think this may be kind of, at least in this gruesome phase of the pandemic, COVID's coda. We do have the vaccine, it's out there, it's effective, it is working. We developed that vaccine in an absolute record amount of time, less than a year, 99% successful. It's just amazing. And also what we're seeing is that the fear drives people to get vaccinated. This morning, I think United Airlines mandated that everybody's got to be vaccinated, and my daughter's boarding school is mandating that everybody's got to be vaccinated. I'm not making a political judgment on that, but more people will end up being vaccinated, and at least the science to this point shows that it is successful at reducing either the transmission of the Delta virus or certainly the severity. So we've got the vaccine out there. It's driving more people to be vaccinated. The virus is evolving into being less lethal. Maybe this ends up being sort of the last act of the COVID show for this period. That would be fantastic. So overall, I will say that these are all things to consider, but perhaps don't quit quite as aggressively on the internet, because based upon my analysis, the Ghostbusters win against all of these seemingly monstrous threats. So Egon, Winston, Ray, Peter Venkman, thank you. We'll let them go. All right, for those of you who track our work, and thank you for doing that, you'll remember that our initial presentation back in January was really about the spoils of war, relating the global catastrophe that was coronavirus to the global catastrophe that was World War II, and looking at the economic dynamics coming out. So we spent a lot of time on that. If you're interested, I believe it's on our website. I put a lot of work into it, so watch it the first time, the second time, or 100 times. In that presentation, we distilled it down to, okay, what's our playbook now coming into 2021 based upon all the frameworks and all the analysis that we've done? And basically, we came up with spoils of war playbook that contained 3 primary plays. I'm going to walk you through those now to assess whether we were on target or off. So the first play was, man, we need to ride this recovery. Right? This is going to be robust, and we need to get all that we can in the recovery. Well, right now, as I've dictated, the economy is at absolute record highs. If you look at the economy at the bottom, it was about $19.5 trillion. I'm not inflation adjusting this. You can, but it makes the numbers more interesting. No. So we were at 19.5 trillion at the bottom. We got all that stimulus. We are at 22.7 trillion today, which pleases Crockett and Tubbs. And I don't know who that is in the middle. Crockett's first wife. Anybody who knows can text me. Anyway, so the economy's at record highs. And guess what? Crockett's really happy with this. Stock prices are also, therefore, at record highs. I looked at the MSCI all cap this morning. It was climbing a little bit higher. This morning, the Dow, the S&P, the all cap world, all at record highs, with the all cap world up 14.5%. So indeed, this is a recovery you would want to ride. And so the way that we positioned the portfolio is to capture as much upside out of this market as we can while balancing risks. And I'm proud to announce that the upside capture ratio on the portfolio is about 115% so far year to date versus 100% for our primary index, which is the all cap world index. So don't get this confused. This is not a rate of return. I'm not saying the portfolios are up 115%. I'm saying the portfolio is getting 115% of the upside on a daily basis of the MSCI all cap world index. So levered towards growth, levered towards the recovery, riding that wave. All right, primary strategy number 2 in the playbook, do not chase momentum in 2021. So back in 2020, value stocks underperformed momentum stocks by about 30%, which was pretty significant. So as reversion to the mean kind of people, we expected the opening of the economy would revive the value trade, and indeed it has. If you look at 2021, values beat momentum by about, I don't know, whatever that is, 11%, 12%. And you can see that was actually a wider disparity up until the Delta growth scare, which again started promoting large cap US growth stocks again. But nonetheless, so far year to date, the value factor within the market's up about 21%, the momentum factors up about 9%. And I think coming in today, Dow was positive, the S&P was positive, the NASDAQ was negative, and interest rates were rising. That's kind of what we expect for the rest of the year. Small stocks lagged large cap stocks by about 5 or 6% last year. That was more pronounced during the most, aggressive part of the drawdown. But in the recovery, they came back, but still didn't achieve victory. So lagging by 5 or 6%. As we come into this year, we expected small stocks would outperform large cap stocks. So again, sort of a reversion to the mean, plus they're cheaper, faster growth rates. In the beginning of an economic recovery, you want to go small, not large. And you can see that dynamic was substantial. So going through, I guess, to about mid-March, Small cap stocks were actually up about 25%, and large cap stocks were up about 5%. So there was a huge delta there. Large cap stocks have recovered a bit, obviously accelerated by the coronavirus fears and Delta in June, but small stocks still have the advantage. We expect that to widen out between now and the end of the year. So in the way that we position the portfolio, if you just look at pure value style holdings, not blend, not growth, we're about 31%, which is an overweight relative to the index, which is about 27. So we got a relative overweight there. We haven't given up on growth, but we're leaning towards value. Never bet the farm on these things. You don't have to, and you shouldn't. But we are making a pretty active bet in terms of size of company within the portfolio. So 43% of our portfolio is not in large cap holdings. So think mid-size, small companies, versus the index, which is about 14%. So the primary driver of our performance, outperformance or underperformance, I suppose, going into the end of the year will be the fate of the smaller names versus the larger names. But we feel confident, and especially with the statistics we saw this morning, that the economic growth will continue to impress to the benefit of the small cap stocks. All right, strategy number 3. We said we want to favor weak dollar winners. Now, it's important to understand the US dollar is a big deal if you're a global investor. And the moments when the US dollar tends to spike are in the moments of fear, right? Remember, we had the Delta scare, and that has taken the dollar up 3%. If the Delta scare recedes, then you expect the dollar to fall. So we think optimism beats pessimism as this recovery continues. Therefore, we want to favor weak dollar winners, not strong dollar winners, which was the story in 2020. All right, if you look at the dollar index and the pink line demarcates 2000s and with 2001's activity, the dollar did decline as the vaccine rollout began and people became more confident that there would be a recovery and we would all survive. And then if you look at the path of the dollar since then, it looks just like case counts. So we had a wave of coronavirus, remember, back in March or April, and then it came back down and we thought we were in the clear, and then the Delta virus came and case counts went back up and it took the dollar with it. So the dollar has been following COVID case counts, but we believe that diminishes, it'll improve stock market returns. And so when the dollar is declining, you want to own things that are not priced in dollars. When the dollar is advancing relative to other currency, you want to own things that are priced in dollars. And so this chart, they were kind of sort of evenly matched as the dollar crabbed sideways in a range until June. And as I showed you, international markets sold off, bought the dollar, bought US assets, primarily large cap growth assets, and that's where you get this delta here. We expect that to reverse as fears of a Delta lockdown subside. All right, here we are. Even though we've got bets around the portfolio, we don't have a super active bet relative to foreign and domestic exposure. We can flex that up in May, but right now we're about 40% on US across the equity portfolio, and the index is about 41%. So really right in line with the benchmark there. Where we do have a little bit of an active bet is on emerging markets. So we got 11% of the portfolio overall dedicated to emerging markets, where the MSCI All Cap, our benchmark, has about 8%. So we got a little bit of an active bet there. I do think that's probably the juiciest part of the market, but there's been obviously some overhang with China tightening down things, et cetera. Emerging markets are least vaccinated, so that's been a headwind. So we could dial that, but for right now, our active bet is 2 to 3%, and okay with that for the moment. So overall, I think we are well positioned for performance and for the win as we go into the end of the year, expressing our 3 primary themes, which is 1, we want to ride the recovery and we think it continues. Some talk about peak growth, who cares? I'll take 4, 5, 6% all day long when our average growth rate is about 2, or our potential growth rate is about 2. And then also, I think you stick with the contrarian plays on value, you stick with the contrarian plays on small caps versus large caps, And then lastly, as confidence rises, I imagine that the dollar falls, and that will again revive returns offshore. And really, with the emerging markets trading at 13 times earnings, there's probably a great contrarian opportunity here too. So I think we're well positioned to continue to perform between now and the end of the year for the win. So thank you, Crockett and Tubbs, for getting me through that. All right, so here's the bottom line. I'm going to land this. Over the next 2 years, including the year we're in right now, the economy will grow 7% this year, give or take. It'll grow 4% next year, give or take. So don't worry, right? Things are good. By the way, earnings are going to grow this year. This number's too low. They may grow 40% in 2021. It's really astounding. But they'll grow at least 30%. And then in 2022, they'll grow another 10%. So as you guess, I really want you to be happy. Don't worry, be happy. Things are good. And lastly, I will say this. If we get into the time machine, hit the flux capacitor, and go back to 1984 and try and look at the runway between 1984 and 1999, there are some similarities and maybe some surprises that I'll share with you now. Inflation on an annualized basis for that 5-year period was 3.5%. That's the big scary number that we got last time that drove all the internet gargoyles crazy. So 3.5% was the average inflation rate between 1984 and 1989. The US dollar declined 6% a year between 1984 and 1989. So inflation, 3.5% a year, dollar deflation, if you will, 6% a year. Sounds pretty scary. And yet, GDP rose 4.5% in real terms on average during that period. US stocks went up almost 16% annualized during that period. And non-US stocks, no, this is not a typo. This also happened to coincide with the rising sun era of Japan. But non-US stocks went up 40% almost annualized over that 5-year period. So if the future looks like the past for this environment here, and I can drill into what order of magnitude I think this will look like. But if the future looks anything like the past, then it's really bright and you gotta wear shades. So with that, Nicole, this is my favorite slide. We are out of time. But I do have time to take some questions. And so I hope you enjoyed that and happy to discuss further. So I'll put the microphone back to you, Teresa, if I can figure out how.
David, that was absolutely wonderful as always. We do have several questions come in. Let me see. Regarding Japan versus US deficit. Isn't Japan's debt held mostly by domestic households versus US debt by China and other countries? Does that make a difference?
I don't think it does, right? Because if you really get into the big debt debate, and that's what's driving the willingness in Washington to add so much debt to the books, the US is a sovereign nation with a sovereign currency. So we can't default on our debt because we can just print more dollars and pay it off. The problem that Greece had was that it didn't have control over its interest rates. That was set in Brussels and in Germany, more like, through the EU. And so they didn't have a sovereign central bank. They had an EU central bank, and they had to go beg the EU for relief. In these sovereign economies that have their own central banks that print their own currency and issue debt in their own currency, they don't have that constraints. So these numbers that we all get hung up on, 100%, 200%, 50%, blah, 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 they don't mean anything. They're just numbers. And then somebody will ascribe context to those numbers. For instance, you can't get into the EU if you don't have a debt to GDP ratio of less than 70%, based on the Maastricht Treaty or whatever it is. Why 70? Well, 70 because somebody wrote an academic paper that said maybe 70. So these numbers are really arbitrary, very abstract. I am not a proponent of taking US debt to infinity. I am suggesting that the rise in US debt isn't necessarily something that mortally wounds us. And the more that that becomes common thought in Washington, the more you'll see bills that are $4 trillion rolling off the assembly line. So maybe all that ends badly. I'm not saying it doesn't. If we get wind of that, we'll change the portfolio. But right now, I'm just not concerned about it as an investor. As an economist and as a student with an economics degree, yes, it concerns me. But as an investor, I'm good right now.
All right. And we are up on time. So I'm going to end with this one because I really like this one. What are the top 3 books we should be reading right now?
The deficit myth is the most important. You've heard me reference that before. I do think that is the playbook for Washington. It's the most important book to read. My favorite book on economics is a book called The Birth of Plenty, which goes back and looks at economic growth from the year 0 to today, and asks the question, what makes it so? And will it continue? And should you be bullish basically on the global economy? I think the answer to that is yes. And I'm embarrassed to admit I'm currently reading a book all about Bitcoin to try and figure out whether there's any there. Don't panic. Don't call Tim Ellis and pull all your money out of WNA. We're not going to roll everything into Bitcoin. I'm just kind of curious about the propaganda around it. And actually, Jamie Dimon quietly released today that JP Morgan's going to issue some securities in Bitcoin, obviously, because the demand's there, even though he said he thinks it's absolute lunacy. So I think that's kind of an interesting thing happening within the marketplace. Do I think it's investable? Not really, but it's pretty nifty and probably need to know about it. So those are the books. I guess one on why the government's doing the crazy stuff it's doing and the logic behind that. 2, should you be optimistic, regardless of what the government's doing long term about the economy? And the answer is yes, The Birth of Plenty. And then 3, there are plenty of pretty good Bitcoin books out there if you're curious about that, but that's what I'm reading.
Awesome. Well, we all anxiously await someday the arrival of a book by you, David. So
I did.
All right. Thank you, everyone, for tuning in today to our 2021 halftime outlook, Back to the Future. Again, we do send out an email with updates from David Waddell and Tim Ellis every Sunday morning. Please visit our website here below. And also for those of you listening, www.wealthstrategists.com, strategist with an S, and you can sign up at the bottom of the website for our weekly email. Thanks again. Everyone will receive a recording, so feel free to pass it on. Also on our website is the ability to book some time with a strategist like me or anyone in our office as well. Everyone have a wonderful day. Thank you again, David. That was wonderful as always.
Thank you. And one thing I'll say in closing is just, we're also having a record year at Waddell and Associates, and that feels good. And I'm super proud of that. So thank you for the confidence that you have in us, but also for the flurry of referrals that we've received. It is amazing and quite a compliment, not only to have your confidence, but also to have your endorsement with your friends and your family. So thank you for that. We're here to serve you. Happy to help in any way, shape, or form. And hope you enjoyed the presentation. Watch it often.
Goodbye, everyone.